Welcome everybody to this session on GST and real property, the key essential for property lawyers. We've got quite a full program today. We're going to be talking about some of the basic rules and concepts in the GST law, GST and developments of land, that is, types of real property and the characterisation of real property for GST purposes, the GST withholding regime, the margin scheme, the going concern and farming business exemptions, as they're often referred to, and adjustments. So we'll kick straight into it, starting with talking about taxable supplies. So taxable supplies are a central concept within the GST legislation, and I've noted out there the elements for a supply to be a taxable supply. So a supply that is for consideration and made in the course or furtherance of an enterprise carried on by, it says you in the legislation, that's the way the legislation reads, but essentially carried on by an entity that is connected with Australia, where the supplier is registered or required to be registered, is a taxable supply unless it's GST free or input taxed. I've got down the bottom indirect tax zone for Australia. We had a change in the law a number of years ago, but for property purposes and what we're dealing with today, Australia is sort of enough for us to look at. Otherwise, we start to get a lot more technical and complicated. And it's usually enough to look at that anyway. So the first element that we have there is a supply for consideration, and that's a nexus requirement that requires a payment act or forbearance. So the definition of consideration includes a payment act or forbearance that is made in connection with, in response to, or for the inducement of a supply. Excuse me. So we need to have some sort of payment or deemed payment, and there needs to be a nexus. It's not sufficient that a payment is made if there's not actually a nexus and it is made for or for the inducement of that supply. This can include things like a barter or exchange arrangement. So if you're providing something of value, it doesn't necessarily need to be cash. If you're providing something of value, you might actually have supplies going either way. So if I make a sale to company A and company A pays me for that with goods or services of some kind, then they will be making a supply to me and I will be making a supply to them as a starting point. And important to note, one that comes up regularly is that the assumption of liabilities can also constitute consideration for GST purposes. Then we look at supply. Supply is a very, very broad concept. So a supply is a supply in any form whatsoever. So it's an inclusive definition in any forms whatsoever, and it can include supplies of goods and services, naturally what we think of when we think of GST, but it can also include the provision of advice or information, the grant, assignment or surrender of real property, or the entry into or release from an obligation to do something or to cease to do something by refraining to act or tolerating any action. So it's an incredibly broad definition. Where we get to when we're analysing GST treatment of supplies is it's about identifying what supplies are actually being made, that you might have multiple supplies, and nutting out which supplies you have. So almost always you'll have some form of supply, and it's about working out which supplies you're addressing. Often in a property context, it will be a relatively simple concept as a starting point, but there are some nuances that can come up on that point. And a supply can be a supply for GST purposes, even if it is unlawful. So you can't get out of it just by doing something that you're not meant to do. A supply is only within the GST net if it is supply that is made in the course or furtherance of an enterprise carried on by an entity. The GST legislation is worded in a very user-friendly, very plain English manner. So it refers to you rather than referring to, the business or the enterprise in many instances. Connection with Australia is usually relatively simple from a GST perspective. A supplier needs to be registered or required to be registered for GST, which we'll go into further later, for a supply to be subject to GST. That required to be registered is crucial. Sometimes people think, supply is not registered for GST, that's the end of the consideration, but that's not necessarily the case. If they're required to be registered, then the supply could still be a taxable supply. And then it's got to be not GST free or input taxed under another provision in the legislation. If it is one or the other of those things, it is carved out from being a taxable supply. So people often think of GST having three types of supplies, being taxable supplies, GST-free supplies, and input tax supplies. I like to think of there as being four types of supplies because it means that you don't forget the first threshold consideration. So the first type of supply, which I've got there, is just simply outside of the GST net. So if it doesn't hit those elements that I mentioned from the first slide, then it will be outside of the GST net. That means that there's no GST charged on the supply. It's not taxable, but there's no entitlement to input tax credits for acquisitions relating to that supply specifically. When I talk about input tax credits, that's the GST concept. It's about claiming back GST for expenses that you've incurred in making supplies. So in a law firm example, if you're providing legal advice and you're registered or required to be registered for GST, you will charge clients GST in respect of your services, that advice that you provide. And you can then claim input tax credits for the GST included in the acquisitions that you have made for the purpose of making those supplies. So a law firm will claim the GST included in the rent that they pay for premises, the GST included in things like stationery and other supplies, and also, phone and internet connections and all of those sorts of things. So all of those GST credits that we claim back are called input tax credits, often abbreviated to ITCs. So that's a very important, crucial concept in the GST law. Where an entity is entitled to an input tax credit, they need to have what we call a creditable purpose. So that's essentially making the acquisition in the course or furtherance of their enterprise and not for a non-creditable purpose, which in essence is for a purpose of making an input tax supply. That'll be a bit clearer as we go through these examples, but that's a very important thing to note. Supplies that are outside the GST net in a property context are usually going to be supplies where the supplier is neither registered nor required to be registered for GST. So that might be the sale of business premises by an entity that carries on an enterprise at those business premises, where that entity doesn't make many supplies and they're underneath the GST registration threshold, so they're not registered for GST and they're not required to be registered for GST. And the other main example is where there's no connection with an enterprise. So if the supply is not being made in the course or furtherance of an enterprise carried on by the supplier, then it'll be outside the GST net. And often we see that in the context of mums and dads selling homes, their own homes. But urge a little bit of caution on that based on some of the cases that we'll touch on a little bit further later. So once we've gone into that threshold issue and we've figured out, okay, we're not outside the GST net, the starting point is that we have a taxable supply unless it's GST-free or input taxed. Where we have a taxable supply, that means we do charge GST on that supply, and we are entitled to input tax credits for acquisitions relating to the supply. So, for example, if you have a vendor who is selling commercial property, they're registered for GST, they're making the supply in the course or furtherance of their enterprise, all of those threshold issues are satisfied. They charge GST on the sale of that property, that commercial property, and they remit the GST to the ATO, and they can claim input tax credits for their acquisitions that relate to the supply. So, for example, their fees that they pay to their lawyer for the conveyancing of that property, they can claim an input tax credit for the GST component of those fees. It's important to think of GST as not being something that ever belongs to a taxpayer. It is just about really the taxpayer charging GST and remitting GST to the ATO, so collecting GST on behalf of the ATO, essentially. It's never our own money. So the next type of supply is a GST-free supply, where we do not charge GST on the supply, but we are still entitled to input tax credits for acquisitions relating to that supply. And you'll probably be most familiar in a property context with a GST-free supply being a supply of a going concern or potentially a farming supply, farmland supply. And the final type of supply that we have there is an input taxed supply. So there is no GST charged on an input tax supply, but generally we're not entitled to input tax credits for acquisitions relating to making that supply. There's an exception there for certain types of supply, not worth going into for the purpose of today's seminar, but just worth noting that in some circumstances there can be reduced input tax credits. So starting point is that input tax suppliers in a property context are usually looking at residential supplies of residential properties that are not commercial residential and are not new residential as defined for GST purposes. So capital supplies and GST registration. As we noted, you need to have an entity that is carrying on an enterprise in order for there to be a taxable supply. Entity, we'll start with that, is a pretty, it's a defined term in the GST legislation. It is something that you will usually have, but you need to figure out and make sure you're looking at the correct entity. So entity includes an individual, a body corporate, a corporation sole, a body politic, a partnership, an unincorporated association or body of persons, a trust, which we know from a legal perspective is a relationship rather than an entity, and a superannuation fund. Same goes for that sort of concept there. And that's sort of mostly what we're dealing with here. It's important to look at which entity we're dealing with and which entity is making the supply and which entity is the recipient of the supply for GST purposes, what capacity they're acting in. So you might have a company that is making a sale of the property and the company is not registered for GST, but if it's acting as trustee for the trust and the trustee is either registered or required to be registered for GST, then you might have some GST consequences of that. Trust registrations and super fund registrations, because their relationships and they're only deemed to be entities for GST purposes, the way the registration occurs is you'll see the registration as the trustee for the ABC Trust. So that's how it's meant to be registered, not Rachel O'Donnell as trustee for the trust. It's the trustee. That way, if you have a change of trustee, you don't need to change your ABN and get a new ABN. It's the trust effectively that is deemed to be an entity and owns that ABN, if you like. So in terms of GST registration, an entity that is carrying on an enterprise is entitled to be registered, even if it's below the GST turnover threshold, where it's carrying on an enterprise. But it is required to be registered if the GST turnover meets the registration threshold. So there's the two questions there. If they're entitled to be registered but don't meet the registration threshold, do they want to be registered? And they might want to do so for various reasons, largely to be able to claim input tax credits for the GST that they incur in the expenses that they have as a business or an enterprise. If they are required to be registered, then they've got no choice and they must register for GST, and all the supplies they make could potentially be taxable supplies, even if they don't register as they're required to do, but then they can have bigger problems if they don't actually register. So carrying on an enterprise, this is a very, very lengthy definition, and there's quite a bit of case law on this point, as well as guidance from the ATO as to their views on the interpretation of what is carrying on an enterprise. Carrying on an enterprise is defined as an activity or series of activities in the form of a business or in the form of an adventure or concern in the nature of trade, or an activities done on a regular continuous basis in the form of a lease, license, or other grant of an interest in property. And there's a bunch of other things that can come within that definition. So, for example, complying superannuation funds and charities are deemed to carry on an enterprise, so they don't need to be doing any other activities that would otherwise constitute an enterprise to be able to be registered for GST, and then potentially required to be registered for GST. Exclusions from that definition of carrying on an enterprise are things like private recreational pursuits. So you can't register for GST to be able to claim input tax credits for things that you spend that are really just hobbies and private expenditure. So that's been tried and shut down very quickly on a number of occasions. And also where you've got your entity being an individual or a partnership which has a majority of individuals as partners, then you are not carrying on an enterprise unless you have a reasonable expectation of profit or gain. So again, that sort of cuts out the possibility of people registering just to claim their input tax credits where they're not actually wanting to make money or expecting to make money. So the registration turnover threshold, this is important for whether you're required to be registered for GST. So the registration turnover threshold is $75,000 for most taxpayers. It's $150,000 for not-for-profits. And it is met if the current GST turnover of the entity is $75,000 or more, and the projected GST turnover, the Commissioner is not satisfied that the projected GST turnover is below $75,000. And the projected GST turnover, or it's also met if the projected GST turnover is 75,000 or more. So where that gets us to is the projected GST turnover is actually kind of the more important aspect. The reason we've got that first bullet point there is it allows for circumstances where, you know, the Commissioner has to be satisfied as to the projected turnover. So you can't have a situation where the current GST turnover is above the threshold and the taxpayer, if you like, just pretends that they are below the $75,000 projected GST turnover. So the Commissioner can't act unreasonably, but the Commissioner needs to be satisfied. Usually that only comes up if you've got a line ball issue or if you've got a taxpayer that's really not doing something that they should be doing. Usually it's a little bit more clear cut than that. Projected GST turnover is incredibly important in the context of capital assets. So capital assets and supplies that are made solely as a consequence of ceasing to carry on an enterprise or to substantially reduce and permanently reduce the size or scale of an enterprise. So if you're substantially scaling down and doing that permanently, then supplies made in that context are not within the projected GST turnover. So what that means is if you've got a taxpayer that's selling off capital assets that would not otherwise be breaching that threshold, then you don't have to register, and you could consider whether you want to cancel your registration if you're already registered. But note that on the cancellation of registration, there might be some increasing adjustments, and I'll explain what they are a little bit later. Few important things to note on registration is that registration is of an entity, not an enterprise. So whilst you need to be carrying on an enterprise to register for GST, it is the entity that is registered. The importance of that is it means if I am practicing as a sole practitioner lawyer, so I'm carrying on an enterprise of giving legal advice, and I also have a little side business, which is profit producing and but below the threshold. So I might make jewelry and sell that on, I don't know, where would people sell that? Etsy, say. That's below the threshold. It doesn't matter. If I'm registered for GST, all of that Etsy business is also within the GST net because the registration is about the entity and then it encompasses any enterprise carried on by that entity. You can look up whether someone is registered for GST on the ABN lookup website, which is quite useful to check that registration, but just be aware of that because registration can be given effect or cancelled with a retrospective date. The Commissioner has the power to do that in various circumstances. So just be a little bit wary of that and keep in mind, because of that, it might be worthwhile having warranties from the other party to the transaction in various circumstances to cover that off and make sure everything stays as it should be. All right, so GST and developments can be a bit of a tricky one. That's something that comes up often in a property context. The benefit of a supply being GST free or outside of the GST net, or potentially to a lesser extent input taxed, is primarily for the purchaser. The vendor will usually, they charge GST, they remit it to the ATO, they can't keep the GST for themselves. So the benefit is really for potentially the purchaser. And the benefits include a duty benefit because duty is charged on the GST inclusive dutiable value, so the higher of consideration and the market value of the property. So if the property is being supplied GST free, then obviously the duty is assessed on a lower amount. There's also a potential timing benefit for the purchaser. If they're not required to hand over GST at settlement, say, then they have the benefit of that money being in their bank rather than paying that amount out and then having to claim it back in their next BAS. There's also a benefit for a non-registered purchaser because they would not be entitled to claim any input tax credits. So it would be better for them if you have a supply that is GST free or potentially input taxed, because they wouldn't be able to claim any input tax credits anyway. So the only real benefit to the supplier is negotiating on the purchase price. So if the purchaser would like a supply to be GST free or input taxed, however it might be, then the benefit to the supplier is if the purchaser has a set amount they're willing to pay and it can be GST free, then that feeds into that negotiation. So the types of real property and the characterisation for GST purposes. The one that comes up very frequently is residential premises. So if the starting point is if we hit those threshold requirements to have a taxable supply, we have a taxable supply unless something else takes us out. So a supply of commercial land or premises, including retail and industrial premises, is subject to GST, it's taxable supply. The supply of vacant land is a taxable supply unless there's a separate provision that treats it otherwise, which we can get into shortly, and that'll generally be your going concern treatment or farmland exemption. And the other exception for property is residential premises. So the sale or long-term lease and the lease of residential premises, the starting point for that is that it will be input taxed, which means no GST, but the supplier can't claim input tax credits for the GST in the expenses they incur. So it's input taxed unless it's new residential as defined or commercial residential as defined. I've noted existing residential there as a non-defined term, if you like, and that's because whilst it's not specifically a defined term, we often refer to it that way because it's residential premises that aren't new residential and commercial residential, sort of the leftovers, if you like. So residential premises are premises that are to be used predominantly for residential purposes, regardless of the term of occupation, excluding commercial residential premises and new residential premises, other than new residential premises that we used before a specified date, which was the 2nd of December 1998. And that is an objective test, and that's important to keep in mind. So that we don't really care, there's some case law on this point, we don't really care what the purchaser is actually going to use it for, albeit that might provide some evidence as to the status of the property. It is an objective test as to whether the use of the property is predominantly for residential purposes. So we don't really care about the supplier and the recipient, we care about the property itself and how it would be characterised. So if we have residential premises, the sale, long-term lease or lease will be subject to, will be input taxed unless we're new residential or commercial residential. So commercial residential includes things like hotels, motels, student accommodations, caravan parks, camping grounds. Certain types of ships can be treated as commercial residential premises, although that doesn't crop up very often in practice. So anything similar to those things is also potentially commercial residential premises. There's a lot of guidance on this definition in terms of the ATO's view. It's also a term that's been adopted by lots of other legislation, such as various duties legislation. So it's very worthwhile, if you have anything that is not super vanilla, contemplating whether what you've got could be treated as commercial residential. New residential premises are residential premises. Again, we need to get in before we get out, if you like. So new residential premises are residential premises that is not previously sold as residential premises other than commercial residential, nor the subject of a long-term lease on that basis, or it's been created by through renovations, substantial renovations to the property, or through a new build of the property. And again, there's a lot of guidance on that point. So, if you slap a coat of paint on a property, that's not going to make it new residential premises. But if you almost tear the whole thing down, but leave a few little bits and pieces up, then it will be substantial renovations and you will have new residential premises. And so it becomes a question of exactly where that line is drawn to for the purpose of that analysis. If you have a property that was new residential premises and it's actually been used to make input tax supplies for at least 5 years, it ceases to be new residential. So what that essentially means is if you are leasing it out as a residential premises, input tax residential premises for at least 5 years, then it changes the characteristic back to just being that existing residential premises. Caution on that, though, there is some case law, and it's consistent with what the legislation actually says. It's a hard test. So you can't lease it out for 4 years, 11 months, and 20 days, say it's no longer new residential. It has to actually be leased, not just available for lease, and not short of that 5-year period. So that's a very crucial one. Moving on now to the GST withholding regime. You would hopefully be familiar with this. It was introduced a number of years ago, basically to prevent phoenixing by developers. And it's under this approach, the recipient of the supply actually pays the GST to the commissioner. So it applies for the sale or long-term lease of new residential premises that were not created through substantial renovation and that are not commercial residential premises. So essentially, that's going to be your new builds that are subject to that provision there, or land that is potential residential land, which is land that is permissible to use for residential purposes, but that does not contain any buildings that are residential premises. So essentially, that's vacant residential land is what that boils down to. So potential residential land that is included in a property subdivision plan. So that's a plan for the division of real property that is registered, however described under Australian legislation, and that does not contain any building in use for a commercial purpose. And the Commissioner also has a power to exclude certain things by legislative instrument. But it's important to work through that definition and tick through, do we have new residential premises? If so, is it in or out? Do we have potential residential land? If so, is it in or out, based on those elements there? And for potential residential land, the recipient is either for potential residential land, the recipient is either not registered for GST or does not acquire the thing supplied for a creditable purpose. So what that's getting there is if you've got an entity that is required to be registered but that is not actually registered, then you're still within these provisions. But if you have someone that is actually registered and is acquiring the land for a creditable purpose, where we get to there is basically they'll be entitled to an input tax credit, then this withholding provision doesn't apply. So the policy behind this is if it would be money in, money out for the commissioner, they're not so concerned. But if it's going to be meant to be money in from the supplier and the recipient's not going to be entitled to an input tax credit, then if the supplier doesn't give that money to the commissioner loses out and has to go chasing it. So that's the circumstances they're trying to get at, where now the recipient has to give that money to the commissioner instead of the supplier. So the GST withholding is usually payable when any consideration other than the deposit is paid or received. That's usually at settlement, but it's important to note that if there are instalment payments or other payments being made before settlement, then you can trigger that withholding requirement at an earlier point. That's an absolutely crucial thing to keep in mind. For fully taxable supplies, the amount to be withheld and paid to the ATO is 1/11 of the contract price, and the contract price is defined as where the contract specifies an amount as a price subject to normal settlement adjustments. So it's essentially, if you say the price is $3 million plus settlement adjustments, then the contract price is your $3 million price. Where the margin scheme applies, the withholding amount is 7% of the contract price, so that's obviously smaller, and I'll get into that a little bit further, but there is a true up later on so that the supplier ends up getting, there's a true up later on, so it ends up having the same result for the supplier as we had before these provisions were introduced. And where there's supplies between associates for less than market value consideration, then it's 10% of the GST exclusive market value of the supply. So you can't tweak the consideration and get out of some withholding as a result of that. So where we have, yeah, there we go. I think I've switched my page. Yeah. So there's two elements to this withholding regime. One is that withholding requirement where the recipient is required to pay the amount to the ATO. The other is a notification requirement by the supplier. So a supplier is required to provide written notice to the recipient in various circumstances. And that notification tells the recipient whether they're required to withhold the amount to pay it to the commissioner, pay it to the ATO. And if so, there's various additional information that needs to be provided, and that includes things like the name and ABN, the amount payable, when it's required, all of that sort of thing. So always tick through and make sure your written notice ticks all of those boxes, because it's a strict liability offence to not comply with this. The standard contracts generally have provisions that address this, but it's important to make sure we actually satisfy them, because I've seen contracts come through that haven't satisfied it. Written notice is not required for the supply of commercial residential premises, nor for the supply of potential residential land to a recipient where the recipient is registered and acquiring the land with a creditable purpose. So again, that situation where the recipient would be entitled to an input tax credit, then the written notice is not required. Albeit that often the supplier will essentially tell the purchaser all of the things that would otherwise be required in that notice anyway, just as out of abundance of caution. It's a strict liability offence, and there's an administrative penalty that can apply. There is an exception where a supplier holds a reasonable belief that they're not required to provide that written notice. So there is some leeway, but these provisions have been in for quite some time now, so there's going to be less flexibility from the ATO for non-compliance. So it's important to make sure that every contract that we issue should comply with this requirement. And I say contract, often the provisions are worked into the contract and the information that's supplied by the vendor in that way, but it can be provided in a separate written notice. So there's the manner in which it's provided can vary, but it's usually done on a relatively standard basis. Non-compliance with the non-compliance with the written notice requirement doesn't impact a recipient's obligation to pay. So if you are acting for a purchaser, it is important to note that even if the supplier gets it wrong, your client still needs to comply. They can be penalised for not withholding and remitting, even if the supplier has got it wrong. So there's very limited exceptions in the taxation administration provisions where that is not the case, and that's most commonly where there is reliance on a withholding notice that's being provided by the supplier, and there is nothing in the contract nor in the surrounding circumstances that indicates the notice was incorrect, and the notice basically said you're not required to withhold, but they were actually required to withhold. So that's very limited circumstances. Best to proceed with caution and to ensure that you don't just allow your clients to say, well, supplier said this, so that's fine. Really drill down into it if there's anything that doesn't seem to absolutely sit correctly. So moving on now to the margin scheme. A sale of land that is subject to the margin scheme is a sale that in effect reduces the GST on a taxable supply of land. So it's still a taxable supply, but instead of being 1/11 of the whole of the amount that's paid for the property, it's 1/11 of the margin. And the margin is essentially the sale consideration less what the purchaser paid to acquire the property, or in some circumstances, a valuation amount. And that can apply, for example, if the vendor had acquired the property before had acquired the property before GST was introduced. That's one of the main times at which you'd look at a valuation instead. But there are other times when you do look at that valuation instead of just being the purchase consideration. The margin is the value added to the property by the vendor, including through expenses that they've incurred. So it is not the vendor's profit margin. I have seen a number of situations where vendors, particularly the unsophisticated ones, but on occasion the ones that you think would know better because they've been in the game for a while, the margin is not their profit margin. they need to charge GST on the margin based on the sale consideration less the purchase consideration or the valuation. Where withholding applies, the withholding, as we've already noted, is 7% of the contract price, and there's a true up in the vendor's BAS, in the vendor's next BAS, which we'll get to in an example because it's a bit easier to see that way. The upside of applying the margin scheme is there's a GST saving, there's less GST payable from the sale price, and therefore less stamp duty, as we've noted before, with things like a GST-free treatment as well. The downside is it's not always available. Some suppliers are ineligible for the application of the margin scheme. And the other significant downside is a purchaser cannot claim input tax credits. So the GST that is charged under the margin scheme isn't something that can be claimed back by a purchaser. That means the context in which the margin scheme is applied is usually where you've got private owners or developers and investors that are on selling under the margin scheme. So if you're having a chain of events and the eventual seller is likely to want to sell under the margin scheme, then you kind of need to make sure it's sold under the margin scheme each step along the way as a starting position. The other context is, so where an ultimate purchaser is purchasing and wanting to live in it or wanting to rent the property out as residential premises, they're not going to be able to claim input tax credits anyway. So if they can't claim input tax credits and you can apply the margin scheme, then often the parties agree to apply the margin scheme. The change of intention is particularly relevant, and I've got their information and documentation. So if you are acquiring a property under the margin scheme, then you want to keep detailed information and documentation to support an eventual sale under the application of the margin scheme, so that you've got all the evidence you need to be able to make that sale at the end. I've seen circumstances where clients have sort of wanted to apply the margin scheme on sale, but they weren't quite sure what happened when they purchased the property. Some of the details weren't kept, some of the information wasn't there, and sometimes it becomes sort of more effort than it's worth. So keep detailed records and make it easier for yourself later on. Some conditions to be able to apply the margin scheme. So it applies to the sale of freehold or strata title, or the grant or sale of a long-term lease. So the sale of a long-term lease there is effectively sort of a transfer, and that's most likely to be relevant in the context of things like ski fields kind of property. You need a written agreement to apply the margin scheme, and that needs to be on or before the making of the supply or within such further period as the Commissioner allows. And because that's a discretion, it is best to not rely on that unless you absolutely have to. So the making of the supply is at settlement for GST purposes. So you want to agree in writing to apply the margin scheme before you actually settle on the property. If you haven't done that before settlement, you need to ask the Commissioner to exercise his discretion. It's best not to do that unless you absolutely have to. It's not guaranteed that the Commissioner will allow it either. So usually the agreement is done in the contract, but it doesn't need to be. You can have a separate written agreement instead. And another requirement or condition is that the property must not have been acquired by a supplier through a supplier that was ineligible for a margin scheme. What that means is that when the purchaser purchased the property, it can't have been, most commonly, it can't have been acquired as a taxable supply without applying the margin scheme. So if I buy property as a taxable supply and it's got full GST, then I can't apply the margin scheme on the sale of the property. The other one that crops up from time to time is acquisitions through an inheritance, and certain related party supplies. So again, if you have something that's not absolutely plain vanilla, you haven't acquired under the margin scheme, then drill into those details to see if you can qualify. The calculation, as I'd mentioned, is the consideration for the supply less the consideration for the acquisition, and then you charge 10% of the margin. So I've got a brief example there. Sale price of 3 million. The acquisition price by the vendor was 2 million. The margin is therefore 1 million, and 10% of the margin is 100,000. So GST in that instance will be 100,000 rather than 300,000. So it becomes 3.1 million, including GST. As I'd mentioned, the GST withholding regime above, 7% of the 3.1, so 7% of the contract price is the GST that would need to be withheld by the purchaser under the withholding regime. That's 7% times 3.1 million, which gives you 217,000. And that means in the true-up, what would happen is, because 217,000 has been withheld, the actual GST amount is the 100,000 that we have on the slide. When the vendor lodges their BAS, they say, Mr. Commissioner, we need to give you 100,000 for this supply, but we can claim back the 217,000 that the purchaser has remitted to the ATO under the withholding regime. So they effectively get 117,000 back in that instance. Sometimes it does go the other way though. All right, moving through now to GST-free going concerns. I mention this even though it's been around forever and a day, just because I'm very accustomed to hearing phrases along the lines of course it's a GST-free supply of a going concern, but it's not always that simple. I highly recommend you familiarise yourself with section 38.325 of the GST Act, because that sets out the requirements for a GST-free supply of a going concern. It must be for consideration, which can in certain circumstances include deemed consideration. The recipient must be registered or required to be registered for GST. It is best practice to be actually registered rather than required to be registered for GST. The required to be registered is sort of a fallback if it's absolutely necessary, but that's not ideal to rely on, especially if there's any chance they might not be definitely over that 75,000. You must have a written agreement. It can be in the contract or elsewhere. And the written agreement must be to treat the supply of a going concern for GST-free purposes. I have had circumstances where certain parties have said, no, this is GST-free because it's a supply of a going concern. That's not enough without the specific written agreement. A going concern doesn't mean a going concern as a matter of law, as a matter of commercial dealings. You might actually have a supply of a going concern legally that is not a GST-free supply of a going concern because you don't have the written agreement. Even if you have a registered recipient, even though you have consideration, even though all the other requirements are met, you need to have written agreement that it is a supply of a going concern for GST purposes. And there's a number of ways that you can word that, but just make sure that that is not glossed over. The supplier must supply all things necessary for the continued operation of an enterprise. So it doesn't necessarily need to be the whole of the supplier's enterprise. It can be, but it must be able to be a standalone enterprise. So, for example, a law firm couldn't make a supply of a going concern of an IT support enterprise, because that would just be part of their law firm rather than a separate enterprise that they have carried on themselves. Whereas in a property context, if you have a vendor that's registered and has been carrying on a leasing enterprise and has, say, 10 properties, they can sell one of those properties as a leasing enterprise, as a standalone, because that can be treated as a separate enterprise. And the supplier needs to supply all things necessary for the continued operation of an enterprise. This often comes up in a business context, a supply of an actual business, where the purchaser already carries on a similar business, says, we don't need premises, we've already got premises, we don't need another office building. If an office building or other type of premises is required to carry on that enterprise, then some premises that are suitable must be provided to the recipient for it to qualify as a GST-free supply of a going concern, even if that particular recipient wouldn't require it. So best to look at it as it needs to be standalone. Could the recipient carry on this enterprise if they started with nothing, if they didn't have anything else? And the supplier must carry on the enterprise until the day of supply. And that often crops up in a leasing enterprise context. Sometimes you might have had a leasing enterprise where the tenant has moved out. You need to, in those circumstances, have the vendor genuinely marketing the property as available for rent, and they need to be doing that actively. It can't just be a notional, that it needs to actively be marketed. So you need to treat it in those circumstances as the vendor wants to actually release this as soon as possible and needs to act commercially in doing that. If you have that situation, strongly encourage that your clients maintain detailed records to be able to evidence that if they have an investigation by the ATO. If a property is being actively marketed for rent, that is not enough to satisfy the requirements if it hasn't actually already been leased previously. So that works for a property that's been rented out as part of the enterprise, vacated and is actively being marketed for rent, that's enough. But if it's say a new build, or they've used it as their own premises and then they decide to lease it out, you need to have had that first tenant in there operationally to qualify for this requirement. And I also strongly discourage circumstances that don't pass the pub test, essentially. So if you have a lease that runs for 12 months and no amount is payable for the first 6 months, then that starts to look and smell a bit funky. If you have the tenant not really intending to ever move in there or not really intending to ever pay anything, you start to get into, firstly, doesn't qualify because it's not genuine. And if you did qualify, then it could be shut down as being a scam. So it's fraught with danger, and it is something that has been focused on by some of the ATO officers that I was speaking to, for example, last week at a GST conference. A few other things to keep in mind. Division 135 adjustment events. So if you make an acquisition of a GST-free supply, that is not necessarily the end of the story for the purchaser. If they wouldn't be able to claim an input tax credit, for example, if they have acquired a residential rental property, then they might have an increasing adjustment. And what that means is they have to give back some of the GST that otherwise would have been payable on the basis that they wouldn't have got an input tax credit for that. Make sure you keep appropriate documentation. I've mentioned the cutover and timing, so make sure that timing is satisfied. Where you've got multiple parties involved, carefully consider what supplies are being made, from whom and when, because multiple parties can give you problems for this. You might still have various supplies of going concern. You might have a supply of a going concern and different things, but it needs to be done carefully. I've got there, why bother? Is it safer to treat it as a taxable supply? Sometimes it is safer. The risk is on the vendor. If you're acting for a vendor, it might be important to have warranties, but keep in mind whether your purchaser might have shallow pockets. But the starting point is, legislatively, the risk is on the vendor. And so sometimes it's not worth the risk for the vendor. I'll touch on this very quickly because I'm conscious of time. You can have a GST-free supply of a going concern where you have a single vendor on two purchases, where if the vendor is just selling a business to one purchaser and premises to another, that doesn't qualify for this treatment. But if on day one they sell the business and grant a lease to the purchaser, they are providing that property that is necessary for the continued operation of that enterprise to purchaser A. On day two, they can sell the premises subject to the lease as a supplier of a leasing enterprise. And then the reverse here, where you've got a vendor that carries on a business on premises that is owned by a related party, for example, you can sell to the one purchaser potentially. You just need to sell the premises subject to the lease to the tenant, and then the tenant sells the business and the lease. So just be careful with managing the timing of that. You can't sell a leasing enterprise where the tenant is the actual purchaser. That doesn't work for going concern. So just be a little bit wary of that. I'm going to very briefly jump over GST-free farming businesses. Worth keeping in mind, if you've got something that might qualify, delve into your definition of farming business. It does need to be a business. It does need to have a profit-making purpose and expectation, and all of those requirements to be a business. You need to have the right intention, and you need to be able to support that with evidence. Get warranties if you need to. It would be best practice to do so. It is possible to have a farming business supplied and also supply a going concern. So some contracts can provide that it is essentially one or both. And it's important to note that whilst there's no specific requirement that you have written agreement between the parties, it just happens as a matter of course that if you have a farming business, it is a GST-free supply. That in one sense makes it easier, but it can make it more complicated for the vendor, because you don't want to be in a position where you treat it incorrectly if it is, as a matter of fact, a GST-free supply. Adjustments. So adjustments are a very interesting one. This comes up in a property context where you have a change of use from an original acquisition. And we have what we call adjustment events, where if you change your use so that you would be able to claim input tax credits, but you haven't, or vice versa, you have claimed input tax credits, but you kind of no longer qualify for all of those input tax credits, there's a bit of a true up and you need to have an increasing adjustment or a decreasing adjustment to pay more to the ATO or be able to get a bit more back from the ATO. You only have an adjustment event if you change from having a creditable purpose, something for which you can claim an input tax credit, to a non-creditable purpose, something for which you can't claim an input tax credit, or vice versa. Where that applies and you have an adjustment event, you need to look at adjustment periods. And these tie into thresholds of the amount that you'd be able to claim. So an adjustment period is essentially a year, but if you have one, the accountants should work through in very careful detail, because it can effectively be almost a year plus for the first one. But essentially they're sort of around a year. And you look at threshold amounts to figure out whether you do have an adjustment or not. So for an acquisition that has a GST exclusive value of $1,000 to $5,000, you have 2 adjustment periods. For $500,000 to $500,000, you have 5 adjustment periods. And for $500,000 plus, you have 10 adjustment periods. So what that means is if you have made acquisitions with a very low price, and you've held them for quite a while and you have a change of creditable purpose to have it or not have it, then you are less likely to have an adjustment. Whereas if you have spent a lot of money on something, there are more periods. So it's a longer period over which a change can mean something for which you have to make an adjustment. An acquisition that was not subject to GST in the first place, or where GST is paid out on the margin scheme, there are no input tax credits available in those situations, so you cannot have an adjustment in respect of those acquisitions. So in a property law context, in a property sale context, where we can have these adjustments is where we have a change of intention that tips us from one to the other. So I've got there, for example, the original intention in that first column. So where you acquire property and you're intending to sell it as a sale of new residential property or something else that's taxable, such as vacant land or commercial premises, then the supplies would be taxable. So taxable, I've got there, yes, new residential in that example there. And you'd be entitled to an input tax credit. You've got a creditable purpose. You'd claim back the input tax credits on that purchase of the property, on that acquisition. But then if you change the intention to either rent the property out, so to use it for residential rent, which has a non-creditable purpose, and or if you are not going to sell it for 5 years and you're going to rent it out for 5 years and then subsequently sell it, then it's going to change from being new residential to existing residential. You've got a change of creditable purchase there. You might have an increasing adjustment to give back some of the GST and input tax credits that you claimed. In contrast to that, if you purchase a property and you initially rent it and you plan to sell it, and then you sell it in less than 5 years. Oh, okay, sorry, yeah. So if you're acquiring a property and you're initially renting it and then you're going to sell it within 5 years, you've got a partially creditable purpose. So you need to apportion your input tax credits based on how much you're planning to get out of the rent and how much you're planning to get out of the sale of the property. So the rent is input taxed, the sale is taxable. You can only get input tax credits for the portion that relates to the eventual sale. If you change intention because you either want to rent it for longer or rent it for less time or to not sell it at all, so continue renting it, then you'll have to change that proportion that you have claimed as an input tax credit if you are within those adjustment periods. Where you purchase property with the intention of renting it out as residential rent and selling it after more than 5 years of renting it out, then you've got supplies that you're intending to make of input tax residential rent and then input tax sale of residential premises. You do not have a creditable purpose. You don't claim input tax credits on the acquisition, but down the track, if you change the intention and you're deciding this rent isn't making it for me, or I actually need to sell it because I need some funds, and you do that within the 5 years so that it is a sale of new residential premises, then you have a potential adjustment on that to be able to claim the GST or a portion of the GST that you hadn't originally claimed. And the final one there, if you have no intention to sell, you're solely planning to rent, you end up in the same position as the one above, where you might be able to get some input tax credits down the track through an adjustment if you actually end up selling it within the 5 years. I will fly through these cases because I'd like to get to I would like to get to a case study. I've got no questions in the Q&A yet, but please put them up if you do have any. So important to note that the property cases really turn on the evidence, and all the relevant facts and circumstances get taken into account. There's a number of cases on characterising whether the supplier is carrying on an enterprise. And as I mentioned, the property issue with, the 5-year requirement to rent out, it's a hard 5 years, and you need to, if you can give yourself problems, or your clients can give themselves problems if they're not actively renting it out for the whole of the 5-year period. In one of those cases, there was problematic marketing for sale. So there was a use that was for marketing for sale as part of that time. So caution on that one. But because it turns on all the relevant facts and circumstances, it's very, very important for your clients to keep all of the necessary evidence. Assume that you will have an investigation by the ATO and you will need to back up your treatment for GST purposes. The taxpayer always has the onus of proof in tax cases. And so the Commissioner can just assess, and that stands until the taxpayer has proven him incorrect. So the first case I want to touch on briefly, and there's a bit more information on these in the paper that will be released in due course, is the Collins case. So in this case, there was a sale of various subdivided lots. The taxpayer had sought to exclude them from their GST turnover on the basis that they were a capital asset and they were ceasing or substantially and permanently reducing their enterprise. The problem here was that the decision found that they'd engaged experts to obtain the subdivision. They had obtained development approval from council to subdivide into 11 lots. They had actually actively marketed and had something that was more than a mere realisation of the best method to sell the property. So they'd been a bit more active here. They'd had what we call a one-off profit-making undertaking or exercise, and they were doing these things to make a profit. Where they did that, that means that the sale is actually not on capital account. It's actually part of the enterprise itself. So they didn't get to exclude it from their registration threshold. They were required to be registered. This is a self-managed super fund in this instance. And the sale was therefore subject to tax. So that was a big issue for that one. The next case I wanted to mention very briefly, and I will end up going over slightly, is Lance's case. What I wanted to mention here is that the arrangements between the parties are absolutely crucial. This is a very high dollar transaction, and the wording of the GST gross up clause referred in a development deed, this is a Queensland property, referred to grossing up in respect of payments, but it was held that there wasn't a payment to the developer. There was essentially an amount that was held and kept over, if you like, as opposed to being an active payment. So the GST gross up clause was not triggered, and that meant that the amount was GST inclusive, which caused a significant problem for the taxpayer in that instance. It was a case between two parties to a contract. The Commissioner was joined as a party because there was an interest in the Commissioner as to how this was treated. sorry, I've just talked about Lance. No, I haven't. I've talked about the previous one. Lance is the last one that I wanted to mention. In this instance, there was a series of activities that the taxpayer conducted, and again, it was an enterprise in the form of a business. They acquired a substantial property and they sought rezoning and subdivision approvals and various other things. They were intending to live in the property, but that wasn't enough because their other purposes outweighed that. And whilst they were intending to live in the heritage homestead on the property, they also had an intended purpose of subdivision and sale of lots for profit and to finance the development and the renovation of the homestead and to repay their loan. So they had evidentiary issues here. They also had some unhelpful newspaper articles that indicated they were doing this as a commercial enterprise. And so the taxpayer was unable to prove that that they didn't have an enterprise in this instance, and therefore it was subject to tax on the sale. I am very conscious that I haven't quite gone through the case study. I don't have any questions. Lisa, did you want me to stay on an extra couple of minutes and go through the case study, or do you think I should leave it to the delegates to have a look through that separately?
Hi, Rachel. Look, I'm happy for you to go an extra few minutes to go through it if you do have the time to stay back. Just to our delegates, if you do have to run off, we will provide you with the recording next week. So if you aren't able to hang on for this case study, you can definitely catch up. So up to you, Rachel.
Great. Thanks, Lisa. I'll go through it because I think it's helpful to work through a practical example. So in this example, development company acquires 4 contiguous parcels of land from separate vendors in July 2022. So some of the other parts are going to be looking forward and assuming that certain things happen down the track. Parcel A was acquired for 3.3 million, including GST, and that was a taxable supply without applying the margin scheme. Parcel B was 3.7, including GST, but that did apply the margin scheme. Parcel C, we've got there $2 million, but it's not subject to GST. So it could perhaps be a GST free supply but going concern. Say, for example, if the vendor had rented out the property as commercial premises previously and the purchaser acquires it as a going concern, so it's not subject to GST, or it could be from a non-registered vendor. And parcel D was $440,000, including GST, and that was a taxable supply also without the margin scheme. Importantly here, development company is registered for GST, and they intend to develop the land to sell it as new residential land. So keeping in mind that the purchasers will be paying GST to Development Co, and then Development Co will be remitting that GST to the ATO, potentially subject to with a holding regime, mind you. So what we're looking at here is firstly the input tax credits, and then subsequently whether we might have some adjustments. So input tax credits here. Parcel A, 3.3 million including GST, no margin scheme. The vendor's intending to sell it as new residential land. That's a taxable supply. So they have a creditable purpose for that acquisition. They're entitled to claim $300,000, the GST, back as an input tax credit. Importantly, they also need to have to hold a tax invoice, a valid tax invoice, to be able to make that claim in their BAS, and the timing depends on how they account for GST. Parcel B, the supply is made under the margin scheme. So we've got there that there's no input tax credits available because you don't get an input tax credit if you pay GST under the margin scheme. Parcel C, $2 million, not subject to GST. So obviously there's no claim of an input tax credit for GST because there was no GST. And then parcel D, which is the same in this instance as with parcel A, it's a taxable supply without the margin scheme, so we can claim the GST of $40,000 back as an input tax credit. So the development or the build is eventually completed in 2031. And at that time, can't sell all of the property straight away. So the developer actually rents some of the property out and has total rental income of $1 million, or at this time anticipates having total rental income of $1 million and total sales of $19 million for some of these properties, all within 5 years. So what we've got there is the sales of $19 million will be sales of new residential property, new residential premises. they will be therefore taxable, and GST will apply to those sales. The rental income of $1 million, because it's residential rental income, that's input taxed. We don't charge GST, but we can't get an input tax credit on the GST paid by us on the acquisitions that go into making those supplies. So that takes us to the question of adjustments. Here what we've got is instead of having a fully creditable purpose, we've got a creditable purpose to a lesser extent. And if I tick through to the last one there, I've got here the taxable supplies of 19 million, input tax supplies of 1 million. So the extent of our creditable purpose is 19 million. That's to make taxable supplies, divided by the 20 million, which is the total supplies of 19 plus 1. So our our creditable purpose is 95% going forward. So what that means back here is we have some potential adjustments. Parcel A, do we have an increasing adjustment? We've claimed all of the GST back. We claimed that $300,000 as an input tax credit when we purchased the property. And we've actually had less than 10 adjustment periods. You might remember that I mentioned the thresholds and the number of adjustment periods. We've had less than 10 adjustment periods here. So we will have an increasing adjustment because our acquisition of $3.3 million for Parcel A is above the $500,000 threshold. We therefore have 10 adjustment periods. So we have an increasing adjustment because we're within that time. For Parcel B, there is no adjustment because there was no input tax credit because the margin scheme applied to that sale. Parcel C, again, no adjustment because there's no input tax credit because no GST was payable on the acquisition of Parcel C. And for Parcel D, we have no adjustment, but for a different reason. And that's because the acquisition there was $440,000, which is in that bracket between 5 and 500,000. So here, we are looking at 5 adjustment periods, and we're past that time. So we are past the time for Parcel D, for which we would otherwise need to potentially make an adjustment. And I've got there also consider other potential adjustments. So whilst we're talking about the acquisition of these parcels, the taxpayer would also need to consider various other purchases that they'd made for all of the things that they've incurred to build and develop these properties. So what it boils down to, because of these amounts, is anything that they've paid $500,000 or more for, they will end up having an increasing adjustment. Anything that they've acquired that paid $500,000 or less for, they will only have an increasing adjustment if they are within that 5 adjustment periods for that acquisition. Just keeping in mind, it might have happened more recently, and so on for smaller supplies, and 2 adjustment periods for supplies between $1,000 and $5,000. So partial A, we've noted in the previous slide that is subject to the adjustment. We initially intended to fully use it for making taxable supplies. So we had a full input tax credit, we had a total creditable purpose, and we claimed back that $300,000 as an input tax credit. That's known as the intended or former application of the thing. That was 100%. As I noted, we've gone from that to intending to use these properties, or to use that property to make a $1 million supply that's input taxed and 19 that is taxable, therefore giving us a 95% actual application of the thing. And because our actual application is less than our intended or former application, we have an increasing adjustment. So if it was changing the other way, we'd have a decreasing adjustment, and we'd actually be able to essentially claim back some of the GST that we didn't otherwise claim. So our increasing adjustment is 100%, our intended or former application of the thing, minus our actual application of the thing, which is the 95%. So that gives us a 5% adjustment. 5% multiplied by the initial input tax credit that we claimed gives us $300,000. And so we have an increasing adjustment of $15,000. So what that means is the taxpayer in their next BAS will need to give the ATO an extra $15,000 when it changes its intention for the use of that property. That's complicated enough. It gets even further complicated if you have different intended or former applications of the thing. So if you're acquiring property partly for a creditable purpose, but not wholly, you will have a proportionate input tax credit at that point in time. And so that can complicate the figures. But just need to step through all the processes to make sure you work that out and get all of those adjustments right. The main thing I'd like you to note there is that taxpayers sometimes forget that once they've claimed an input tax credit or not claimed an input tax credit, that's not necessarily the end of the story. If your clients change their intention of the use of a property, they might have an increasing or decreasing adjustment. So that's it for the case study. Thank you for those who've decided to stay around or have come back to listen to the case study part of this. Still no questions, so I might head back to Lisa at TEN. Thank you very much for your time.